Welcome back. Today we're gonna continue with the next article, right? So let's begin with the next article, Article 10 for the book. So what are you gonna read today? We're gonna read about the differences between equity and derivatives market. Are you ready to start? Okay, let's go. The number of investors using algorithmic trading system in Vietnam is still limited. As an estimate, 98% of algorithm trading system in Vietnam operate on the derivatives market, VN30F futures contracts, but not on the equity market. This is due to fundamental differences between the two markets as follows. Time to complete transaction. Differences in completion time explain why more than 60% of algorithmic trading prefers derivatives market to stock markets. This can be understood as the algorithmic trading system that can trade at high frequency in the derivatives market is rather limited in the stock market since the wait time takes up to 1.5 days to sell. So now let's talk about database complexity. Most derivatives trading algorithms use technical analysis that includes only price and volume data. They are easy to collect and organize into a database. In contrast, trading algorithms on the equity market use fundamental analysis, which requires full financial statements from all listed companies in Vietnam. They include income statement, balance sheets, and cash flow statements. These reports usually have different structures when it comes to company types, like insurance, securities companies, conventional companies, or even banks. Databases in the equity market have specific requirements in the data structure, query speed, and data cleaning, etc. The database complexity is much higher in the equity market compared to the derivatives market. Note that when using multivariate algorithms, the database gets even more complex. These algorithms require more types of data besides financial statements. Now it's about fees and taxes. Taxes and two-way transaction fees in the derivatives market are only about 30% of the stock market, excluding price slippage. From this perspective, the derivatives market looks more attractive to investors. However, in the long term, trading in the derivatives market may incur higher fees if investors opt for high-frequency trades. There's no daily transaction limit in the derivatives market. In summary, there are three main differences between algorithmic trading in the equity market and in the derivatives markets as follows. So let's look at this table. So they are completion time, database complexity, fees, and taxes. So as you can see here, between two markets, equity market and derivatives market. For most algorithmic traders, the derivatives market is more attractive due to the three main differences of both. However, at Algotrade, we are working on algorithmic trading for both markets, as fundamental analysis proves to be highly valuable. There are also opportunities for market-neutral strategies that combine both markets at the same time for higher efficiency. So we already know about the differences between equity and derivatives market. That is the end of Article 10, and I hope you have a great weekend. See you next week for for the next article. Goodbye.